Hello, everyone. My name's Don Smith. I'm with SSI Consulting, and I'm here today with Bernie Casey. He's our financial specialist that is going to be talking to us today about cash flow. So good afternoon, Bernie.
Good afternoon, Don.
So Bernie, let's start off with maybe you can explain what is the difference between working capital, cash flow, and net profit.
Okay, a simplistic definition of the three elements. Cash flow, starting with cash flow. Cash flow is an immediate bird's eye view of your liquidity. So it's kind of like inputs versus outputs. It's very immediate, it's very short term. I mean, you can certainly measure it for longer periods of time, but they become less significant as they reach out farther. Because you're really playing a guessing game to some extent. Working capital is more of a balance sheet item. It's more a measurement of your liquidity. It's like taking your liquid assets and comparing them to what you owe in short-term debts, taken in a 12-month period. That's kind of the normal example for working capital. So it's my liquid assets minus my short-term debts. What do I have left? That's considered your working capital. And net profit, well, that's where you take your revenues and your expenses, but you have to also include the credit that you're extending to make those sales and also the expenses that you're incurring to make those sales. Well, what's left over after all of that is the net profit. So it's kind of the juice.
Okay.
After the sale. I hope that explains it to some extent. I think people sometimes look at profitability and they make assumptions based on profitability, whereas the more important element is cash flow, because if you run out of cash, you'll never get the profit.
Okay.
You need cash flow to achieve the profit.
All right. So here's a question for you. So thinking with the hat of a business owner on here, I went to the bank and they refused to bump up my revolving line of credit. I was convincing, and my business is profitable. So why are bankers so hard to deal with?
Well, actually, I guess you could say they're not really that hard to deal with. It's your circumstances dictated the answer you got, from the point of view that they're looking at how you're managing those resources that you can manage. They're not looking at the economy as a whole so much, or trends that are occurring in the marketplace that you have no control over. They're looking at how you're managing those resources that you can effectively change, such as the turnover of your inventory and the speed of your collection and how you pay your bills, and the speed with which you pay your bills. Those elements you can effectively manage. And obviously, perhaps you weren't managing them well enough to qualify for that additional credit. So that's kind of the easiest answer. It's more complicated than that, but that's a simple answer.
Okay.
Cash to cash cycle is kind of the thing that one should be looking at measuring, because that's the measurement of, you started out with a certain amount of cash, you had to buy inventory and pay labor to get a certain product, which you then sold, but you didn't get the cash back again until you collected it. So that total cycle time is kind of an efficiency measurement for you if you add that together. So it's really the inventory time and also the sales process time, which includes collecting, minus the accounts payable duration, the amount of time you take to pay your bills to your suppliers. So if you take that number, that's kind of an efficiency number that you can use to rate yourself. Is it getting better? Is it getting worse?
Okay.
The bank is certainly looking at that.
Okay. And that's the cash to cash cycle?
Cash cycle.
Okay.
It's kind of like it's like rounding out your cash flow. It's like saying, uh, this is how efficient I am. Now,
Yeah.
there's all kinds of limitations on your efficiency, depending on what type of business you're in. Obviously, if you're receiving cash every time you sell something, that's quite different than extending 60-day terms to someone.
Hmm.
So, there's quite a variation in business. Like in some businesses, you have to manufacture the goods, so you have to put it in inventory, and then you have to process those inventories into final product.
Mhm.
That's quite different than just having a finished product immediately from a supplier that you then just sell. So
Mhm.
there is quite a variation depending on the type of business you're in. But the banks know all that.
Yeah.
They also base your credit on the margining of the receivable. And what that means is they look at the receivable and they say, I'm sorry, they look at the amount of credit you're extending in your revolving line of credit, and they say, what's supporting that credit? Well, what's supporting it are the receivables in the inventory, but they take a factor of the inventory and receivables. They don't take the full amount.
Right.
They say perhaps it's 75% of your less than 90-day receivables, or perhaps it's 50% of your inventory. Those two numbers added together have to be greater than the amount of credit that you're being extended. So that's part of the equation.
So for someone, a business owner that's having some cash flow challenges, right?
Yeah.
What's your view on factoring of receivables?
Factoring of receivables is a very expensive way to borrow money. It's a short-term solution. It's basically taking the receivable and selling it to them on paper. Really, all you're selling them is the purchase order and the shipping document to prove that it's actually been shipped out. You're selling those documents to that person, and then when the money is collected, you have to pay them back.
Right.
But you have to pay them back plus their interest.
And
So
it's
there's
generally pretty steep.
it's fairly steep.
Yeah.
The only way that it makes sense is if those are incredibly good incremental sales. Like, let's say you're going to double your sales and it's very profitable, then certainly factoring the receivables is a consideration.
Yeah.
It's not a first choice, but it's a consideration.
Right. Right. Okay. Okay. So, do you have any final thoughts that you want to share with people in terms of cash flow?
I think the best tool you can ever use is one where you're trying to measure. You have to have some sort of measurement system. If you just use your bank account as a measurement system, that's not good enough. As the business gets more sophisticated and the numbers get bigger and more zeros are added, you really need to break down things. You have to say, this is how much money I have, this is how much I have coming in a certain number of days or day, and this is how much going out. So you have to regulate the flow. You have to say, this is how much I can flow out
Yeah.
when this amount is flowing in. You have to balance it,
Mhm.
because if you flow out too much, you're gonna use a lot of borrowed money,
Yeah.
and not so good.
So thanks for your time, Bernie. And so for all of our friends out there, if you have any questions, you can put them in the comment section below. Bernie will be happy to respond to them. So with that, I hope everybody has a great day.